Way it'll run today is going to be food coming out very soon. So, you won't go hungry. Please enjoy that. There's a bar at the back. Make use of that as much as you can. We're very lucky to have Tim Fung here. Tim is the CEO and founder of Airtasker. So Tim will take you through the story of Airtasker. We think it's at a really critical point. UK, US business is growing really nicely. We've been a shareholder for a couple of years now. From Dan and I's perspective, I think the main objective just from our presentation is to share a bit more about our process, our strategy. Some of you have been in the fund now for 7.5 years, so it's quite a long time. The market will do whatever the market's going to do. We can't control the returns, but we control the process and the day-to-day strategy that we do when we analyze those businesses. And I think as investors, for you guys understanding that, it's useful. Okay, if you narrow down what we do to one sentence, we're patiently investing in undervalued and overlooked securities. And that undervalued, overlooked piece does a lot of heavy lifting in the sentence. The core holdings that we have today are all very profitable, 10, 20, 30. Cuscal does $50 million of profit a year. They've all got big balance sheets. Airtasker's got 20 mil, Coldstate's got 50, Paragon's got 40. So for companies of those size and that quality to trade down to valuations attractive enough for value investors like us, there needs to be some sort of cloud over that business short term or over that stock to have it trade at a price that's attractive to us. We'll get into that, but we make our money or we get paid for identifying those short periods when the markets roll. I won't go through all of them, but probably the one to call out would be alignment. I think from day one, sort of hammered home that alignment's been important to us. All my money's in the fund, has been since day one. Never take any money out. Every time we got some extra cash, I put it back into the fund. My best friends are in the fund. My family's in the fund. They have substantially all their money in the fund. So it's right alongside your money as well. So alignment's important to us. Team. So Dan joined us in January. It'll be 3 years. Which has gone really, really quickly. I said to some of you when we brought Dan in as co-founder, as a partner, co-CIO, that the main reason we were doing it is it would be beneficial to your returns, to investor returns. The cool part about 3 years playing out is that I don't need to promise it anymore. It's starting to see it in the numbers. It's factual. I think we're doing really good quality work. I really enjoy working with Dan, so I think that'll continue into the future. Eugene. So we did our Melbourne event 2 weeks ago. I think everyone in the room knew Eugene was. In Sydney, probably less do. Some of you will. But Eugene was the first external investor in a vehicle that I managed, going back many years now. At one point, it was myself, my grandma, and Eugene in the vehicle. And he's been a big supporter. He's been a director of our company, Capital H, which then became HD all the way through, and a big advisor as well. So when there's problems or questions that are too hard for Dan, we go to Eugene. So do appreciate his support over many years. Okay, strategy. So I want to take you through the steps we go through to analyze the companies that we invest in. The first one is, what is the downside? So this is the most important step, because if we don't get past step one, there isn't a step two. So what is the downside really means? What can we lose? What's the risk? What can go wrong? And the way we do that is that we look at the business that we're analyzing. We make a worst case assumption on what that business does over X many years, figure out how much cash it generates over that period, and then value those cash flows. So we value the business. Then we can value or compare the worst case valuation to the price on offer in the market, and it's attractive, there's not much downside, then we're interested. Up on the slides here, sort of 5 features that if you've got a company that has all of those, probably a lot of downside protection. The one that's probably worth pointing out would be recurring revenue. Of all our core holdings, the most common feature across all of them, despite having very different business models, is that most of them have substantially a large portion of recurring revenue. That doesn't have to be contracted revenue. It can be different. I think like a Microsoft Office, nobody locks me into using PowerPoint to build the slides, but I'll probably be doing it again in 5-10 years regardless. A business we're going to talk about a little bit tonight, FSG, fire safety compliance. You can't occupy this building as it gets ticked off by a professional. Doesn't matter if in a recession or rates are 1% or 7%, you still got to pay FSG. You get it ticked off. So we like companies like that have downside protection. Okay, so after step 2, comfortable with the downside. The next part is how much can we make? And the stock price is really just 2 things. It's the earnings per share the company generates, and that's the multiple that the market's willing to put on those earnings per share. And the change in a share price, it was only overcomplicate it. It's just a change in those 2 things. Yeah, grab a chair, guys. Jump in. Grab a drink too. So our first job when we're trying to find these companies is we're trying to identify companies that are very likely to have earnings growth 5, 10, 15 years into the future. There's a lot of companies that we can't figure that out for. It's too hard. they're too cyclical, too seasonal, or it's just too difficult for us, and we just put that in the too hard basket, and we stick to the companies where we actually can get very confident that they're almost certainly going to be more profitable in 5, 10, 15 years. So what you look for is a company that's in a growing market, so they've got tailwinds. Hopefully you can find data that shows they're winning increasing share in that growing market over time. Hopefully they're going to benefit from scale, so that as you get more revenue, margins expand, and earnings grow faster than revenue. And then the final one is that there's some way they can redeploy excess cash, whether it's buying back cheap stock, M&A, or some sort of opportunity in the business to juice EPS returns. And then the next piece is the multiple expansion. So multiple expansion is the market paying more for the same earnings per share. So it's hard to predict when it's going to happen or if it's going to happen sometimes. But what you can do is you can look for certain qualities that a business has that's likely going to attract multiple expansion. So for us, the two most important ones would be certainty or predictability of earnings and duration of earnings, so how far out it's likely to grow. For us, all else equal, duration and certainty are far more important than just growth by itself in any given year. Example that would be a Cuscal. Cuscal will never have a year where they double their profits in a year. It's not that kind of business. It's kind of a boring, sturdy, predictable business. But in 5, 10, 15 years, we're all going to be putting more transactions through our phones. I'll still be subscribed to Netflix. We'll be paid online. Population will be bigger, and so there'll be a bigger pool of money going through digitally. Cuscal is well placed to keep winning a bigger share of that, and so that's why we expect it to get multiple expansion rather than earnings growth in any given year. What's the market missing? So this is really just about remembering that the market is almost always right, and that's really important. I think it's important to remain humble that most of the time the market is correct. We get paid for those really short windows where we get it right that the market's wrong. Really good businesses, the kind of business that we want to own, don't trade cheaply for very long. So you've got to be ready. You've got to have done the work in advance so that you can swing when it's actually available. I think the key point here would be test assumptions, because the market is almost always right. When you think it's wrong, you really got to go and test your work and back up the assumptions you're making. So we speak to management. That's obviously a big part of what we do. It always will be. But you can't just speak to management, at least for our process. You go and talk to a CEO and a CFO, and they will always tell you their product's the best, their service is the best, they're better than competitors, the staff left, that was a good thing for the business. And they're usually not lying, they usually genuinely mean it, but it's biased, right? So we take that information, and then what we do to test assumptions is we kind of speak to anybody that will listen to us. We'll speak to any stakeholder that we think we might get interesting information from. It can be customers, it's a really good one. Ex-staff is a really good one. Ex-directors, competitors, franchisees. And for most of those meetings, you're hearing the same thing. You're kind of validating the information that you got from somebody else. And so you tick that that's all good. But then every so often you get little nuggets of gold from a customer that says, oh, we just couldn't switch it too hard, or the product's by far the best. And that's where you sort of validate those assumptions. And those little meetings like that can sort of invalidate or validate a thesis by themselves. Position size. So got past step one, you're comfortable with the downside. You're comfortable with the upside. You think you can earn a return above your hurdle. You think you know what the market's missing. The last piece is probably the piece that's talked about least. Maybe the most underappreciated is position sizing. An example of this, I'm not trying to think on the mid-cap fundies here, but an example of this would be that a lot of the mid-cap funds do own a lot of the same stocks, but their returns can vary greatly. And one of the big reasons is they've got different position sizes. So it is very important. There's a couple of ways that we think about and approach position sizing. One of them's up on the screen, which is the Kelly criterion. All the Kelly criterion is it's a formula in finance and gambling where you're trying to optimize the position size. So underinvesting is a mistake too. If you have a really good opportunity, you need to bet enough, you need to invest enough to meet your return hurdle. You know, we have investors that expect us to make a certain amount of money every year. And of course, overbetting is a mistake too. You don't want to risk so much that you lose more than you can tolerate. Sometimes in investing, you can do perfect work. You can do exactly what you were supposed to do, and things can just happen, and that's life. And so you need to make sure your position size, so if things happen, the worst case happens, you don't blow up, of course. And the Kelly criteria is a way to do that. Well, two things that I point out where there are a lot of similarities in gambling or speculating and investing in terms of pricing risk and finding mispricings. But there's two really important differences. One is in gambling, the probabilities of each outcome are known and they're fixed. So every time I flip a coin, I know it's 50-50. Whereas in investing, I don't know. I have to go and do the work. I have to hopefully do good quality work and make good assumptions around what each outcome, which is most likely, which is least likely, and try to price it. That's one difference. The other difference is that in gambling, if you go down to Crown and you put all your money on red, it comes up black on the roulette table. you're done. Like you lose your money, you get zero back. In investing, if you've done step one, partly it's the way that we invest, value investing, if you've done step one of what's the downside really well and you've nailed that bit, oftentimes you can get it wrong and still get substantially all your capital back if you've done that well. So that's where we try to focus on that downside piece. I'll be really quick here. There was an investor in the 60s and 70s called Shelby Davis, and he invested mainly in insurance companies. He coined this term, it was called a Davis double, which is when you invest in a stock and you get the earnings growth piece right, so earnings go up, and you get the multiple expansion piece right. So in our game, it's kind of like a home run. A Davis double for us is a home run. Fiducian is a listed small cap integrated financial services player, does advice, funds management, and platform. We bought the stock in 2023, about $5.70. It's roughly doubled since. We did get the revenue right, and we got the margin right, which meant the earnings grew faster than revenue. But worth pointing out that the biggest difference here is the multiple expansion. That was the biggest kicker in the return. When we bought the stock, small caps were kind of unloved. They do have a business model where their revenue is partly tied to what the market is. They take a percentage of asset values. And so a business that had with EPS and dividend per share growth of 15% for 20 years, pretty phenomenal. To buy it on 12 times what was too cheap. And then as the clouds sort of dispersed, people stopped worrying about what could go wrong. It's re-rated to 22 times and been a Davis double for us. I won't stay too low on this one. One I'd probably like to point out is overlooked companies. We really do love overlooked companies. We love when there's a bigger fund who's sort of discarded the stock. They're selling the last of their holding. They're probably doing it at a price that's very immaterial to them because they've got a much bigger fund than we have. That's very material to us. We love if there's no broker coverage or brokers have ceased covering on a few years back because it's just unloved. No one's looking at it. That tends to mean it'll be a liquid, and we're okay with the liquidity. We just focus on getting the thesis right. If you get the thesis right, generally liquidity will come. And because we're small, we can still be relatively nimble compared to other funds. And the other one is just proprietary research. Because almost all the stocks that we cover don't have broker research, we kind of have to build it up from the ground up, and we're very happy doing that. Okay, a couple of updates on some of the companies. So one of the things that makes us different is that we can invest in private companies. We've always been able to do that. That was written into the fund from day one, but we said we'd be very selective. An example of how selective we are is that we only have 2 private companies in the fund after 7.5 years. They're about 5% each. McGrath, most of you will know, John McGrath spoke at our Investor Day last year. You know, probably a legend of the real estate game. Very lucky to be backing him. We bought our stock when it was still listed. It got bought out by Knight Frank and Bailey's, and we got offered the chance to roll some of our equity and take 2/3 off in cash. So we did that. It's a hard one to share updates on in our letters because it is a private company now, so I don't want to share information that I haven't got approval to share. But we did get their annual report for the year just gone, FY25. Cash EBIT was up significantly. They pay us a 10% dividend yield, which comes in every quarter. It's fully franked. It's held very conservatively at cost on our books, and we're happy to be a long-term shareholder there. There is a private equity fund involved in that whole transaction that happened, which means there probably is a chance of an exit potentially for us at some point, but we're quite happy just to hold that long-term, be passive, and just let John do his thing. Frontline's different. There are a couple of guys from Frontline here today. Frontline, we have a large shareholder. We're very active in that, or Dan's very active. Any of the credit, I think Frontline's going to be an emerging success story for us. All that credit goes to the guys, Tom and Nate and Dan. I'm just up here presenting it. But that started with the acquisition of a Newcastle-based fire safety compliance business. So testing the equipment, making sure it's all safe. It's a legal requirement if you want to occupy your building. The first acquisition was Frontline Services Group in Newcastle. There were several others after that. So the geographic coverage now is sort of central coast up to the north tip coast of New South Wales. Those businesses have all performed well, or better than expected. And I think we've acquired well, so that it's now held at about 2.5 times EBITDA on the balance sheet. You know, these are companies that larger versions are selling for much higher than that. So we obviously do think that's cheap. Our valuation policy has and always will be that we always hold everything at cost until there's basically an event the auditor says you have to revalue it. So that's a capital raise or it's a takeover or some substantial acquisition of stock by a third party. One update we can give is FSG's in advanced discussions to buy a very similar size business. If it happens, it'll probably be early next year, Feb, March, something like that. It'll be mostly debt funded with a bit of equity. The equity would be issued at a price double what we carry it at, which is probably just fair value, to be honest. But that's just an example of I guess, the value that's there. If that happens, it's going to mean that in the letters that you guys get, it's going to look like one big 5% jump. But remember, it's not that. This value is being gradually accruing for 3 years. It's just that the valuation policy means that it's happened like that. So it's not done and dusted, and deals can fall over, but we'll keep you updated, and we do think that could be some good news soon. Another thing that makes us different is we can invest anywhere. We will always be 80-90% ASX listed equity. That's always a plan. That's our sweet spot. But we did build the mandate open, so there's something that's a no-brainer to us, but outside the usual mandate, we can invest. The Property Franchise Group is the only non-Australian business that we own. It's like a bigger, probably more stable version of McGrath. It's the largest group of agencies in the UK. Dan had known this business for over 8 years. That's really critical. We wouldn't do it if we didn't know the business integrally. It's now 6% late in the fund. We acquired our stake, an opportunity to acquire a line of stock probably 18, 24 months ago. And so we did it because it was too cheap. Fantastic business. They had a record up until COVID of growing every single quarter for decades. It's not a record I'd seen that was similar in Australia. It was really impressive. So we took that opportunity. Obviously, it's very early days, but you can see it's done well thus far. Edge, I won't spend much time at all here, but we always think constantly about what our edge is at a strategy level and what our edge is at the actual individual stock level. If you don't have an edge, I think it's going to be very hard to make money long term. So that's very important to us. This is just a graph that kind of gives you an idea of roughly where any given time your capital will be invested. Like I said, 80% ASX equity right now, probably always going to be that way. The 6% in international is just TPFG, the business just explains, and the 10% private equity is 5% FSG and 5% in McGrath. Okay, year in reviews. This is 30 September 24 to 30 September 25. These are the core holdings, a bit of an attribution analysis. I think any fund you're in, it's worth asking them for an attribution analysis that I already give it. It just kind of shows you get the net gross return, but it's nice to see where the actual gains came from. Two positives here would be all the core holdings were nice contributors, which is good. Cogstate and Cascale were the biggest. But probably the other big plus for us is there weren't any big losers. So we did step one of figure out your downside, protect your downside pretty well in the last 12 months, which we're happy with. Okay, that's our scorecard. I think about this way too much, but this is how we compare ourselves. This is what matters, especially the long-term numbers here. So 15, 16% since we started 7.5 years ago. Time's gone really quick. That's actually quite a long track record. There's plenty of funds out there with longer, but there's also not many that have this long. So I think we're happy with that. Then the quality of the work that we're doing is really good. And like I said, we can't control the returns, but I feel like the quality of the work that we're doing will deserve sustained good returns. Maybe even a little bit more room for improvement as well. Probably worth pointing that out is that we do have a big chunk of the fund that's in McGrath and in FSG that have been held at cost and have not contributed anything to the fund, despite obviously, at least in our view, there's been value accrued there. So we feel happy about it. Pretty much any index you could compare us to us, we have outperformed over the long run, and that's certainly the goal to keep doing that. No surprises here. This is our top 5 holdings. All of them, Cogstate, Premium, Cascale, Laserbond, and Airtasker, you would know well. One of them you're going to get to know a whole lot better very soon when I stop talking. Probably the one to point out here that maybe stands out a bit is Laserbond. It's probably the newest of the core holdings. It's smaller than the others by market cap at just 65 million. I think it's worth pointing out they probably will make 10 mil plus of EBITDA this year. So it's a fairly substantial business. The market cap makes it look smaller than it probably is. But they're all good quality businesses. Like I said, they all had their own individual, whether it was company related or market related or a bit of both, reason for why the stock traded very cheaply. And they've re-rated and contributed, as we saw in the slide before, as the clouds have sort of parted and the market's seeing the positives again. We're open for investment. Obviously, really do appreciate the support over many years. Many of you have been here from day one, which is awesome. Many of you have topped up the whole way through. I think the key point here is that any dollar that comes in, we've got ideas. Like we are putting capital to work. We have more ideas than we have capital. If a dollar came in tomorrow, our brokers are here. They're going to get the order flow, and it's going straight out the door to buy those stocks we think meet all the criteria that I outlined earlier. So the returns have been good. It's been a good year, but we do really think there's good opportunities out there to keep finding. Cool. All right, I'm going to bring up Tim from Airtasker. Yes, they go green, white. What's something
Awesome. Thanks everyone for having me today. So I'm Tim. I'm the co-founder and CEO at Airtasker. And we'll just thank Harley and Daniel for inviting me to come in and sort of just do a spiel for 15 minutes or so. So I'll try and I'll maybe just tell you a little bit of background about the Airtasker story and sort of how I came into doing this crazy thing that we're out there doing. And then make some room for some questions at the end. So feel free to ask me anything. Like, I love spicy questions that are hard to answer, and I'm just getting in front of all of those things. So happy to do that. Just reflecting on how I met the guys. It's actually really interesting. So we've been through a journey where I went through like crazy VC hype, raising money at crazy valuations, like literally like having like these crazy burn rates, and like you wouldn't even know what's happening in the office, and having parties where like literally there's like, people swinging off chandeliers, quite literally swinging off. You wouldn't think that happens, but it does actually happen. This crazy stuff, because when you start a company in your 20s and your young 30s, just shit happens. Went through that, through the hype of COVID and the craziness of COVID, through public listing a company, having $1 billion valuation for a while and $2 a share, coming all the way down to 17 cents a share, I think, at the peak, at the absolute nadir, and then getting a call from these guys. And you're talking about value investors who are like, finally, and some money. Obviously, like, I think the business is rooted around a value, but these guys are like some of the very, very, very first people at the absolute nadir of our thing who are like looking around. Where it's like, these guys are going to make some money. So hopefully they make everybody here some money that they've been really, really supportive, have gone on that journey. And I think since then, we've sort of come up a little bit from that absolute nadir, but still got like a crazy, crazy way to go, I believe. So maybe just starting a little bit of background. As I mentioned, Tim, founder and CEO, born and bred here in Sydney, went through public school all of my life here in Sydney. I came out and I did a marketing degree in university, but somehow found myself doing an internship at Macquarie Bank in their real estate capital investment banking division. So how did I end up there? Basically, my degree in marketing was actually in tourism and hospitality marketing. And I remember I was working at this hotel in Darlinghurst, called the Altamont Hotel. And I saw on the new UNSW jobs board that there was this job that you could get where you'd work with Greg Norman and Steve Waugh and all these like cool Australian like sports people. So I'm like, I should like apply for that thing. So I ended up applying for it, ended up being at Macquarie. And the reason why was that Macquarie was building out all of these golf courses with Greg Norman in a joint venture, and they were doing cricket communities with Steve Waugh as a joint venture. I was like, that doesn't sound cool. I ended up doing 5 years chained to my desk doing quant analysis in an Excel spreadsheet. Steve Waugh and Greg Norman did walk into the office every now and then, but they got to have the lunch, and I would just be like crunching the numbers. Left there in 2009 in the last GFC. And I wanted to do something more like interesting and sort of creative in my career, because I never was suited in quite into investment banking. And so I was watching a lot of the show Entourage with which is like about Mark Rubio growing up in Los Angeles and like all this like cool stuff. And there's a character called Ari Gold, who's like the celebrity talent agent. He's the guy who does all the deals on behalf of the actors. And so I want to be like that. And so I looked up like where are all the places I could work in the industry where that was like that. I ended up making this like super ostentatious brochure about myself, which was kind of like a resume, but it had like photos and like my interests and all this kind of stuff. And I mailed it out to all of the talent agencies in Sydney. And I ended up getting one reply from a woman named Ursula Hufnagel, who is the founder of a company called Chic Management. And so Chic runs a lot of the model search competitions in Australia. Ursula was a model herself, and then became a model scout and agent, and ended up building this enormous like empire basically of elite models, but also running celebrities and other aspects of entertainment. So I ended up as an investment banker going in there, like literally in my shed and my slacks, into the office, and they gave me a chance. I said, I'm really good at doing PowerPoint presentations, because for the past 5 years of my life, I've done nothing but PowerPoint presentations. So she let me be a talent agent, or to assist some of her celebrity talent agents. When I'm sitting there, this man named Peter O'Connell actually walked through our office, and Peter was one of the founding directors of Optus, and was pretty senior guy at Babcock and Brown, and done like a lot of like really like highfalutin stuff, and happened to own part of this modeling agency just as like a side hustle. It's actually quite a big modeling agency, but it was his side hustle. And he goes, "Who's this guy in my office?" And he actually gave me the opportunity to work with him on a bunch of different startup ideas. He's like, why are you doing these PowerPoints for, these celebrities? Come and help me work on some things. So we worked on a whole bunch of ideas, like a Bahrain oil fund, a motor scouting competition, all of this different stuff. But the thing that he actually let me work on that was successful in the end, was a company called Amasim. It was a mobile SIM card business. We came up with the idea of it at the back of the modeling agency, and we put together a PowerPoint deck, and we ended up raising about $50 million of private capital, mostly because he was a successful guy who could leverage his name. Over the next couple of years, we hired about 150 people. We built an office. We did a deal with Optus, and we scaled this business to about $50 million in revenue in a couple of months. And at that point, I was kind of like, oh my gosh, like this is how people start businesses. You just come up with an idea, you just go do it, and then that was like eye-opening for me. And so my co-founder Jono and I, we were the first 2 employees of Amasim. We were looking around for things to do, and I was moving apartments at the time. I asked a friend to come and help me move. That just made us think, like, why do you ask your friend to help you move when there's so many people out there who would actually want to help? And my friend was literally like, I get asked to help people move like all the freaking time because he has a truck that he uses to do deliveries. Just really like so freaking annoying. Everyone asks me to help me move. And so we're like, why does that happen? And what we kind of worked out is like the internet at the time was like a dodgy place. No one could find anyone to help them with all of these kinds of jobs. And so we're like, can we just sew that up? Like if you could fix that problem, people could like trust someone else, then they wouldn't have to go and ask their friends to do those jobs. So that was the genesis of the idea. We toyed around with it for about 9 months. And I remember I used to live with my roommate, and he worked as in superannuation. And basically I'd pitch him all of these startup ideas. I'd be like, this is a good idea, this is a good idea, this is a good idea. And most of the time he'd go, like, that is absolutely shit. That is so bad. And when I pitched an Airtasker, actually like, it's not terrible. And I was like, okay, good. Okay, that's a good start. So we then went to a couple of friends who worked at like Bain and McKinsey and stuff, and they were like, oh, actually, it's not a terrible idea. The underlying thesis of this generally makes sense. So we literally started the business on a little office on George Street with a bunch of developers and engineers who are literally like the smelly developer engineers who are like working out of this tiny office and eating burgers every day and all that kind of stuff. So it was literally that kind of startup thing. We launched the site in 2012, and it was really, really freaking difficult to start. So one of the things about Airtasker is it's truly a two-sided marketplace. As a customer, you can come to us and post a job for anything that you need done. And as a tasker, you can come to our site and say, yep, I can do that for some price. The crux of that is you've got to get people to be like describing a job on the platform, but also in the knowledge that there's actually no one on the other side. Like when you're starting from zero, it's an incredibly difficult thing to do. So we spent the first 7 years of the business literally just grinding it out, throwing mud at the wall and trying to figure out what sticks. It went from like, we literally tried everything. Like I would do a lot of the tasks in the beginning. Like someone would post a task, we would have, if no one's going to do that, no one's going to do that. Does this, you do this, one do this. And then, we'd go do it. And literally one of them involved me burning around in my Integra Type R, trying to pick up KFC for someone. And so I would do that. And then I remember I delivered it to the guy, and he was like one of our investors' friends. And I'm just like, I've literally burned that again, like 3 KFCs trying to do this. My co-founder, Jono, helped open, close, and clean a lot of like retail stores. And literally was like, do anything it takes to make this thing succeed. We also went through a phase where literally I would say, I need jobs on the platform. How am I going to go get them? And I remember going to a deal with a bunch of like real estate agents, because we're like, these real estate agents need people to hand out, do letterbox distribution. And so I would literally go to a real estate agent and go, give me 20 G's and I'll go and work out how to do this letterbox distribution. And then I go to Airtasker and I'd post up like hundreds of regular jobs on the platform. And if you want to talk about like, absolutely doing whatever it takes, literally like a lot of my holidays and weekends were taken up with real estate agents calling me, going, hey mate, those flyers that you said your guys were delivering, they've been thrown in a bin in Newtown, and I'm driving to Newtown and getting flyers out of a bin to try and solve this. But a lot of that, I think, is what built the character of what Airtasker is, which is we've got a real culture of just do whatever it takes to do something that is incredibly difficult to do. So a few years into building the business, and I had a business coach, and we're talking about like, what is the long term of Airtasker? Why are you doing what you're doing here? And I remember one of the most powerful things is that you're like creating this really cool service where people would like post up tasks and get cool things done, and there were some like heinous tasks happening on the platform, like some really really cool things. One of the things that was so powerful is we would meet people through our platform and they'd say, hey, I'm an exchange student from overseas. I was actually going to get booted out of the country because I got like no money to keep going here. And I started the platform and I'm like making a couple of grand, a month doing tasks on their platform. We met a woman who was like, I actually was abused by my partner and I lost all my confidence and I couldn't go out and get a full-time job, and it wasn't possible for me to go work full-time. But through Airtasker, I just started doing like one job, and then that was pretty cool. So I went and did two jobs, and I'm like working full-time and getting all these jobs through your platform. And it was actually at that moment that we actually anchored the business around a mission statement, which is to empower people to realize the full value of their skills. In other words, a two-sided marketplace, but we're really working for taskers, and we believe that every single person's got skills that they can use to do something for someone else, and we can help them make money out of that. And we really wanted to align ourselves around that. So over the course of doing that, we had to raise a lot of money. We're burning a lot of money, as I mentioned before, because starting a marketplace requires you to invest a lot up front. You got to build that network effect, because once you've got it, it's just so valuable. We came across, we were raising a round of funding, and one of the things, one of the people that we pitched to is actually Tim Fung, who was the CEO of Channel 7 a few years ago, and he actually loved what we were doing at Airtasker. And so we needed to raise this money, and he said, hey, take this capital, I'll invest some cash in you guys, but we got to take this advertising too. You got to take a couple of $1 million of advertising and go and spend on it. I want equity for that. And so at that time, we're kind of like, fine, we'll take that deal because we really need the money. We ended up doing it, and we had a few $1 million of advertising on our balance sheet. And, and I'm sitting around going, oh man, like TV, that sounds like pretty hokey. Like who watches TV still? That everything's, Google, SEO, Meta, etc., etc. But, typical Airtasker starter, like, well, we got it. We may as well go hard. And so we filmed a television commercial. I don't know if any of you guys saw it. It was called Like a Boss. And it had like this Asian woman who was like talking about a ping pong table and lying to her husband about how she would deal with these jobs, but they were really done by someone on Airtasker. We put her up, and it turned out that over 5 years of doing this advertising with Channel 7, that we were able to slowly build up our brand in Australia. And over time, we reached about 65% brand awareness. So about 2 out of 3 people in Australia know what Airtasker is. A very large number of people in Australia think of Airtasker as the first place that they'd go to for a handyman or a cleaner or a gardener. And we were able to 20x our revenue, get to about $200 million of gross marketplace volume in Australia. This is sort of like $200 million worth of tasks that are happening through the platform each year. So we then went through COVID. That was obviously really, really an interesting situation for Airtasker. As COVID came up, we're sort of doing hundreds of millions through the platform. But then they announced these lockdowns, and they're kind of like, no one is able to physically connect anymore. We're like, okay, that's the end of Airtasker. Because quite literally, that is our mission statement. That's literally what's on the front page of the newspaper. I remember sitting down with that chairman, I'm like, okay, so this thing's probably going to close to zero for at least a period of time. So like, how do we get ready for that? And I remember we actually had internally, we'd written a protocol, guys, at 40% revenue drop, we're going to fire this many people. At 60% revenue drop, we're going to fire this many. And in true active like transparency and accountability and honesty as leadership, we actually presented that to our team. We said, hey, everybody, we're telling you this is what could happen. And, we're just telling you in advance. And it was actually quite an amazing thing that happened. What we saw is that although the volumes dropped about 30% like overnight when they did lockdowns, we immediately started growing back. And like, what the hell's going on here? And what we discovered is that although people didn't need domestic cleaners and they didn't need people coming into their homes, they actually did need home IT services to set up their home office. They needed people to do like a remote fitness training, on Zoom. They needed people to write COVID safe policies. They needed people to like clean up after, certain events and things like that. And so what we realized then is like, this platform's actually bloody resilient. And why? Because we empower other people to make the most out of the situation. We're not going to tell you this is what you're going to use Airtasker for. We're going to tell you this is a platform where you can find people to do stuff for you. And so we actually saw it accelerate during that period. It was disrupted when the lockdown started, but then growing out of that. And so at the time, Afterpay was absolutely on a tear on the ASX. So we're like, let's go do that. Let's copy what Afterpay is doing, because if we can tell a story, deliver on that story, raise the money, and then deliver on the next story, that is an amazing, amazing opportunity. So we did that, listed on the ASX. It's a huge boom on the day. We actually had what I realized now is a really terrible situation, which is that we listed the company at about 60 cents and it went straight to close to $2 in about 3 days. And it sounds really cool. Like everyone's like, oh, that must have been really cool. It's so uncool. Basically what happens is you rotate out all of your good investors and you end up getting a lot of retail investors coming on. And then what you also get is you get a bunch of investment bankers going, oh, you got to raise money because the share price is so high. We're like, but we don't need any money. And they're like, yeah, but you got to raise money to do it. And we literally getting people coming in, you got to go buy this company. We're like, but we don't want that company. And they're like, but you got to go buy it and then like they literally show you the last page of the slide deck and it goes, see, that's how much accretion is. You don't buy it. We're throwing that much money at. We're like, but seriously, just fundamentally, I don't want that company. So that was like a really, really crazy situation. And it was kind of good until about for all of 2021, but it just absolutely fell off a cliff in 2022. And since then, we've grown our revenue like 3x. But the valuation, everything has been like really undervalued, which is why I think the guys are pretty like spot on, sort of like spotting what's up in there, because literally the revenue multiple is just absolutely compressed into something that was very hard to something which is clearly undervalued now. So moving into the future, what's Airtasker working on? One is that we worked out that this deal with Channel 7 in Australia was really, really helpful for us. It's a contrarian bet on the fact that instead of investing all your money with Google and Meta and TikTok, actually Channel 7, Channel 9, or immediate, completely undervalued, because it's not cool anymore. If you're a CMO and I'm going to go invest on like radio, you kind of get shot in the cool community. They kind of, that's not very cool. What about TikTok and like Instagram stories, all this shit? Turns out that it's actually like much cheaper to advertise in some of these uncool channels. So we're replicating that. And in the UK, we've done a similar partnership with Channel 4, which is I guess the Channel 7 of the UK. And then we've gone to the US and we've done similar deals with iHeartMedia, Sinclair Broadcast Group, the Times of India, and a company called Televisa Univision, which are all multi-billion-dollar media companies over there. And they're helping us to scale Airtasker into these new markets. And we're doing that all in a way in which they invest in the incremental opportunity that we have over there. So we're not betting the house. We're not betting what we've built in Australia. We're saying, hey, we're starting a new company. We'll own that company. It's the USA company. And then we're getting these guys to help us grow that company and giving them a share in that upside. But of course, keeping a big share of that for ourselves. Last thing before I get off the stage is to say, after doing that $50 million of these media deals last year, we realized that we needed to do like something to make that media work harder for us. We're like, we got $50 million of radio ads, outdoor ads, television ads. And we're like, hey, we should go get a celeb or something, so that when we make those ads work, it's actually cool. So we went and hung out with a bunch of these Hollywood execs, and I actually did find myself in the Ari Gold style office, and they're like pitching us, you should get Ryan Gosling. You should get this guy Terry Crews. You should get, it actually did pitch us Meghan Markle a few years ago. But anyway, pitch us all of these people we could use. And so we said, look, none of these deals are going to work for us because the way all of that stuff works is that you pay a celeb and the celeb literally goes, thanks for your money. I'll give you 2 Instagram posts. And if you make a TV ad, call me and I'll turn up and I'll say my one line and all that. It didn't work for us. And then one of the agents started saying, hey, you should do this. You should take a look at the Red Bull Formula One team. You're like, yeah, this is a good marketing platform. And I'm like a massive Formula One fan. So I'm like, it's like no way that I can tell my boohead that we're gonna advertise or do a sponsorship in Formula One because they're gonna know that I'm full of crap. Like I'm like literally, it's easier if you pitch me like a golfer because I have no interest in golf, and I can be legit in saying that this is a good idea. Anyway, so we kept saying no to that. We then got invited to go to the Singapore Grand Prix. They're like, oh look, just make the team, go to Singapore Grand Prix. And I'm like, hey guys, we're not doing this deal. I'm just telling you now, we're not doing it. And as we're in the paddock, saying no, we were literally seeing guys in the background wheeling around sets of tires, and they were seeing people cleaning the car, and then some guys sweeping the garage floor, and some other guys fixing the IT wireless router for the garage. And a big group kind of came to us. We're like, hey, can we not sponsor the cars and the driver, but could we sponsor that guy? The guy who's sweeping the floor in the garage because he looks really cool. And so we actually ended up coming up with something I think is pretty innovative, which is that we don't sponsor the car, we don't sponsor the fancy ass drivers, but we do sponsor the team behind the dream of one of Red Bull's Formula One teams. And so when you see them do the pit stop, you'll see Airtasker in the pit, you'll see Airtasker all over their overalls after the guys doing the pit stop. And actually last year, at the beginning of this year, we actually said we should really spotlight these people who do real tasks behind the scenes with real skills. And so we actually put up the EA, the rear jackman in the pit stop, and the garage logistics manager, and massive billboards around the Melbourne Formula One Grand Prix. And the reception of feedback that we're getting on that is really, really incredible, which is that's amazing because it's mission aligned. It's really what Airtasker stands for. And it's a great way for us to build trust with our users as we scale from Australia to the UK, the US, and further across the world. So thank you, everyone, for hearing my rant tonight. Happy to take any questions, but also happy to get off the stage and have a glass of champagne. So thank you.
As far as tasks go, it's what are ask percentages of the this? What's the main about that's asked from Apple? What is there? So it's asked. And you really is this?
So there's a short answer to that and a long answer. The short answer is that there's 5 categories that make up roughly 40 to 50% of the jobs, and it's what you'd expect: cleaning, gardening, handyman, moving, and IKEA furniture assembly. So it's it's jobs around the home. But I think there's 2 things to say within that answer. Within those categories, there's a long tail of types of jobs that happen. One thing that most people think is when they think of a cleaner, they imagine 2-bedroom apartment cleaning on a fortnightly basis. That's what pops into most people's heads. But if you look at the cleaning tasks on Airtasker, it's legitimately I've had a party, need someone to clean up after that. I've got an end of lease clean. I have a barbecue, it's all covered with grime, I need someone to clean it. And none of these things are services that you can just buy now. You can't really go to a company and say, hey, can you help me clean up after a party on the weekend? It's a one-off, it's bespoke. So we get a lot of that. The other thing to say is that in that other 50% of the tasks, it's this crazy long tail. It's insane. Over Halloween, we have all these people making Halloween costumes. I need someone to come over my house and hang up all the cobwebs over. I need someone to make, a Rick and Morty costume for my kid, and all of these kinds of things. And I think the power of a platform is actually, it enables what you don't know. It's not us kind of saying, oh, we think people want cleaning, let's offer them cleaning. It's actually saying, we don't know what people want, but we know that they want stuff that we can't imagine that they want. So if we give them the canvas or the platform to be able to do that, then maybe, they'll tell us what they want. And that's exactly what Airtasker does. And that's kind of our secret sauce, actually.
It's very fast between the customer and the employer.
Yeah.
It's very great.
It's all results based. It's do this thing for me. I think that I want to pay about this much. And then taskers will say, I need to be paid this much to do this job for you in this way. And you agree that through our platform. That's what makes it scalable. As soon as the job starts to become, we're going to tell you what the price is, we are going to, be involved in the transaction, then we're not a platform, and then it completely doesn't scale. And so the whole concept it is almost the perfect embodiment of a free market. Oh, sorry. That was kind of an important app. So one of the things is that we make money as percentage of what goes through our platform. And so we're really held accountable to not just like advertising or like clicks or like page views or some of that. It's a percentage of the job's value that goes through our platform.
Well, I think it's
yeah.
So exactly, if I put a net up and just say it's $100, I transact.
Yes, you transact
just through your platform, and what do you get?
About 20%. Yeah, it varies on different tasks. So for the taskers, it's like the more jobs you do, the less you pay. For the customers, it depends on the task value, but it averages out at about 20%. So one of the really crazy things was when we started Airtasker, we actually didn't start doing payments. It was just a classifieds essentially, and we would just assume that the payment happened. And then about 3 years into the business, we said, hey, for business reasons, we're not going to be able to raise VC funding unless we're actually processing these transactions. So we that was actually the catalyst, like, total honesty. That was the reason why we did it. And then when we did it, we just saw volumes take off. And what we realized is that actually the taskers really want the escrow. They want the money to come in the middle because they get all these like non-serious customers. Like, if you think about it, you can like say, oh, hey, painter, come over to my place, do this thing. And then they come in and, nah, get out of here. I'm not going to pay you. And the reverse is also true. If you're a customer, you might have a painter agree to do something for you, and then, they don't quite do the job the way you want. And so it turns out that they're screwing the payment by taking the payment at booking, and Airtasker, a trusted brand, holds that money for you, and then only paying it out when the job's actually done is actually like a huge trust builder and value creation for our users. So we were actually being greedy capitalists, but it turned out it was great for users, so that was good.
Is that being paid for?
So we have two sides of it. We have a small fee that's paid by the customer and a bigger fee that's paid by the tasker. Yeah.
Were you by that? How are you getting?
Yeah, so yes, we're definitely like they've actually been around for like 2007 or something, and we're kind of like, they're not doing that good a job. We reckon we can go and smash these guys. One thing that was always different about TaskRabbit and Airtasker was they decided that they were going to have a application process to become a tasker. So they were kind of like, everyone who wants to become a tasker, just come and apply, and then we'll verify you, and then if you're good, we'll add you to the pool of taskers, and we'll give you a separate app. And, if there's too many taskers in an area, we'll say no. And if there's not enough, we'll say, we'll try to recruit. And we're just like, well, that doesn't really make sense, because like what is good to one person isn't necessarily good to another person. Like, we can't decide on who's good. It's sort of like if YouTube said, hey, all the videos, just submit your video to us. We'll just do a quick check of your video, and then we'll post it up online. It's like, that doesn't make sense. We're like, it's got to be a platform. So that was one thing that's always different between Airtasker and TaskRabbit. But then more recently, TaskRabbit got acquired by IKEA. So they've gone down this route of being more like Uber for IKEA furniture assembly. So it's also creating some clear air for us, which is good. So yeah, pretty confident we can sort of take it to them and beat them. I think there's one Chris at the back there.
One of us doesn't matter. For the peak type business, like how do you get two parties to continue to transact on the platform and not create a private arrangement?
So this is like the question that I ask myself in every bath, every shower, every moment. Is like, how do you do this? So there are a couple of things that I would say to that. The first is that it's not the same business. it's actually a different business. When you're connecting two people, really what you're doing is you're introducing and you're making a fee on an introduction. And that tends to be a low frequency, but very high margin business. Like, for example, if you're like a broker or something, it's kind of like, hey, I can introduce you to you. I was like 5% of the value of your home or something. But it's like, but just once. Once they know each other, that's out. The second thing, the second kind of business, and the repeat business, is actually more about us providing value in terms of security, safety, payments, insurance, convenience, all these kinds of things. And that is a high frequency but low margin business. So we started with the first kind of business because it actually turns out it's a very profitable business. And we now have a very profitable business doing that. Maybe we want to have the second business too. And so we are working on that. We're actually doing millions of dollars of jobs per year in people saying, hey, I want to come back to the platform because frankly, it feels dodgy to just call someone outside the app and be texting. And it's the Wild West. Like, you have no idea what's going on there. So they want to come back through Airtasker, but we are continuing to iterate and innovate on how we're going to keep them in that loop. One of which is we, about 6 weeks ago, reduced the price from used to be a double-digit percentage number. We've reduced it right down to 3 or 4% because we think that, frankly, the value equation has to be such that you're like, of course I'm going to use Airtasker. I'd be crazy not to. But it's a lens tool which I could talk about for literary hours because I actually do spend hours per week talking to our product team about how to build that out. But we are confident that we can actually 3x the size of our marketplace in Australia once we get that really, really right. Like it's the majority of the marketplace is actually that.
Where do you see the business past 10 years?
So there's two aspects or two vectors that we're really working on there. One is we know we have a product that works, it's very, very profitable. And so we are scaling the crap out of that. And we're starting with Australia, the US and the UK, probably to the broader developed English-speaking Western world, and then probably to the broader non-English-speaking Western world, i.e. Western Europe and things like that. So that's one vector of just like international growth of the bread and butter of our business. And then the other is in two main vectors. One is in driving frequency. So the gentleman was speaking about repeat bookings, and nailing that is literally where we spend like a lot of our time. And the second thing is into businesses. So what we've seen is that companies like Oscar Wiley, Aesop the Soap Company, Showpo, Hello Molly, all of these kinds of like retail businesses, literally use Airtasker like hundreds or thousands of times per year because scaling a national workforce is a really, really hard thing to do. Like if you just need all of my retail stores across Australia, need a handyman every now and then, that's a hard thing to do. So there's a big opportunity in small business or large business using Airtasker too.
Is there a vetting process for the service providers to minimize, you and I guess unsavory characters going on your platform?
The vetting process is that the customer chooses the person that they want to work with. And so I think actually the best analog for this is like a dating website. Like if you imagine Tinder or Hinge or any of these platforms, it can't be that Hinge, the company goes, oh, this was very attractive. Go on this date. It's going to be fantastic. You're going to have a great time. Here they are. They're available at 7 p.m. on Friday. And it's actually quite similar when you think about what Airtasker does. We're actually engaging someone to do a job, which is quite personal to you and what you need at that time. And so the way that Airtasker works is we don't ever tell you that anyone is good. We actually go, here's a bunch of information. You can look at their ratings, their reviews. Have they got a working with children's check? Have they got a trade license? Have they been ID verified or tax verified by Airtasker? All these, but they're all optional. And why is that important is because every job is different. If you want to get 200 people to walk down George Street and hand out leaflets for your business, you don't need them to have a working with children's check. And if you applied that lens to all of your users, you would completely remove all of these people. On the other hand, if you're hiring a babysitter on Airtasker, you absolutely would want to work in children's check. You probably also want a police, ID check. You probably want a background check. And so we offer all of those things, but we never push our agenda onto you. It's like you choose, and it's very clear that you're choosing. Exactly. It also turns out that's a much better business model because the business model of like, this person's definitely awesome. And then they just turn up 5 minutes late and suddenly the customer goes, this person turned up 5 minutes late. I want a full refund for that, blah, blah, blah. And so we're like, no, right, you choose. It's up to you.